November 3rd, 2008, 11:47 p.m. Detroit, Michigan. The lights are still on inside the Renaissance Center. General Motors stock closed that day at $5.23. Just 16 months earlier, on July 16th, 2007, it had traded above $42. The Dow Jones Industrial Average had already fallen more than 30% from its October 9th, 2007 peak of 14,164.53. Lehman Brothers was gone. AIG was surviving on federal oxygen. The Troubled Asset Relief Program had been signed into law on October 3rd, 2008. Inside a sealed executive conference room, Rick Wagoner studies a liquidity forecast that shows cash running out within months. Someone mutters the word bankruptcy. The smell of burnt coffee hangs in the air. Outside, factory shifts are being cut. Suppliers are panicking. Dealerships are going dark. And yet, buried in a separate binder on that same table is a different set of numbers. GM Financial Services revenue, extended warranty reserves, parts and service margins. Because even as the company was dying on the assembly line, another machine was still humming. The machine that makes money after the car is sold. That's the part nobody talks about. The public thinks automakers make money when you buy a car. The real story is what happens after you drive it off the lot. To understand it, you have to leave the showroom and step into the 12th floor of the Glass House in Dearborn, Michigan, in the winter of 2006. Alan Mulally had just taken over as CEO of Ford Motor Company on September 5th, 2006. Ford stock hovered around $8. It had been over $15 in 1999. The company was bleeding billions. On December 5th, 2006, Ford mortgaged nearly every major asset it owned, factories, real estate, even the blue oval logo itself, to secure $23.5 billion in loans. At the time, it looked like desperation. In reality, it was preparation. Because Mulally understood something Detroit had forgotten. The car is just the entry point. The real profit is in the ecosystem. Historically, American automakers made their money on volume. Henry Ford II empire thrived on scale. In 1955, Ford sold over 2 million vehicles in the United States. Assembly lines roared. Steel clanged. The smell of oil and grease defined industrial America. But by the late 20th century, the economics shifted. Manufacturing margins tightened. Competition intensified. Japanese automakers refined efficiency. By the early 2000s, the average profit margin on a new vehicle sale for mass market brands could be shockingly thin. So where did the money go? Into financing. In 1919, General Motors created GMAC, General Motors Acceptance Corporation, to finance car purchases. It was revolutionary. Instead of waiting for customers to save cash, GM would lend them the money. By the 2000s, financing had become a weapon. In 2006, before the crash, GMAC was generating billions in revenue, not just from car loans, but from mortgage lending through its residential capital unit. That decision would later become catastrophic. When the housing bubble burst in 2007 to 2008, GMAC's mortgage exposure imploded. On December 24, 2008, GMAC received $5 billion in TARP funds to stabilize its balance sheet. Think about that. The financing arm of an automaker required a federal bailout, because the real risk wasn't in metal, it was in money. Even after GM filed for Chapter 11 bankruptcy on June 1, 2009, GMAC, renamed Ally Financial, remained central to the company's recovery. Why? Because auto loans are predictable, long-term revenue streams. When you finance a $40,000 car at 6% interest over 72 months, you don't just buy a vehicle. You sign a 6-year revenue contract. And automakers often package and securitize those loans, selling them as asset-backed securities to investors hungry for yield. The car becomes collateral. Your monthly payment becomes a financial instrument. By 2015, U.S. auto loan debt surpassed $1 trillion. By 2023, it exceeded $1.5 trillion, according to Federal Reserve data. That's not a side business. That's a shadow banking system attached to every driveway. But financing is only the first layer. Step into a dealership's finance office. The fluorescent lights flicker slightly. Papers slide across a desk. Extended warranty. Gap insurance. Prepaid maintenance plans. Paint protection. Each product carries margin. In many cases, dealerships make more profit in the finance and insurance office than on the vehicle itself. And automakers participate. They design warranty structures. They sell branded protection plans. They manage parts distribution networks, because parts are gold. The markup on replacement components can be enormous. A sensor that costs a few dollars to produce may retail for hundreds. Service departments rely on proprietary parts and specialized diagnostics. Modern vehicles are rolling software platforms, and software doesn't just fix problems. It creates subscriptions. In 2014, when Mary Barra became CEO of General Motors on January 15th, she inherited not just a car company, but a data company. The ignition switch scandal, which led to at least 124 deaths and a $900 million settlement with the Department of Justice in September 2015, damaged trust. But while the headlines focused on safety, another transformation was happening quietly.
Telematics.
OnStar. Connected services. Vehicles began collecting data on driving behavior, location, diagnostics. That data became monetizable. Insurance partnerships, subscription features, remote services. In 2022, BMW made headlines for experimenting with subscription-based heated seats in certain markets. Public backlash followed, but the concept was clear: hardware installed, software locked behind paywalls. You thought you bought the feature. In reality, you leased access. Tesla took it further. On June 29, 2010, Tesla went public at $17 per share. Many laughed. By November 4, 2021, Tesla stock closed at $1,229.91 before its stock split. Tesla doesn't just sell cars, it sells software updates, autonomous driving packages, premium connectivity. The full self-driving package has been priced as high as $15,000. That's pure margin. No steel, no rubber, just code. Traditional automakers watch carefully, because once a vehicle is connected, the revenue never stops. Insurance is next. Some automakers now offer usage-based insurance products, leveraging driving data to price policies. Instead of letting State Farm or Allstate capture the premium, they step in. It's vertical integration disguised as convenience. And then there's depreciation. When you trade in your vehicle, the automaker's certified pre-owned program captures margin again. Lease returns feed dealer lots. Financing recycles. The same vehicle can generate profit multiple times over its life cycle. This wasn't accidental. It evolved from crisis. After 2008, Wall Street became ruthless about return on invested capital. Investors didn't want cyclical losses tied to manufacturing volatility. They wanted recurring revenue, subscription models, financial services. After the pandemic crash on March 23, 2020, when the Dow closed at 18,591.93, automakers faced plant shutdowns and semiconductor shortages. Production fell. But profits didn't collapse proportionally. Why? Because pricing power increased. Financing remained strong. Used car values surged. In 2021 and 2022, average transaction prices soared above $45,000. Interest rates climbed as the Federal Reserve tightened policy. Longer loan terms, 72, even 84 months, became common. Monthly payments stayed affordable. Total cost ballooned. You weren't just buying a car. You were entering a financial ecosystem designed to extract value for years. And here's the darker layer. When General Motors exited bankruptcy in July 2009, the new GM shed liabilities and brands. Pontiac gone, Saturn gone, Hummer sold, lean, focused, and more dependent than ever on high-margin vehicles and financial products. The lesson of bankruptcy wasn't humility. It was optimization. Optimize the revenue per customer. Stretch the lifetime value. Modern automakers talk openly about customer lifetime value on earnings calls, not vehicle profit. Customer profit. The language shifted. The psychology did too. American consumers often experience status anxiety, fear of falling behind in a competitive culture. That anxiety drives upgrades, new models, higher trims, trade-ins every few years. Each upgrade restarts the revenue clock. And when electric vehicles enter the picture, the strategy evolves again. Battery warranties, charging subscriptions, over-the-air feature unlocks. The vehicle becomes a platform, not a product. On July 28, 2022, Ford reported second quarter earnings showing strong demand for higher trim F-Series trucks and robust Ford credit performance. The pattern repeats across earnings reports. Financial services divisions provide stability when manufacturing fluctuates. Because lending is predictable, driving is continuous, and maintenance never stops. The real smoking gun isn't a secret memo. It's the structural shift from product-based revenue to ecosystem-based revenue. You think the transaction ends at the dealership. For the automaker, it begins there. The car feeds the loan. The loan feeds the interest. The software feeds the subscription. The data feeds the insurer. The parts feed the service department. The lease feeds the used market. It's a loop, a closed financial circuit wrapped in sheet metal. Meanwhile, some factories in Detroit still stand half-empty reminders of the 2008 collapse. Workers who lost jobs during the recession never fully recovered. But the financial arms grew stronger. Ally Financial, once GMAC, became a standalone publicly traded company in 2014. Ford Credit remains a cornerstone of Ford's profitability. The machine learned from near death. It diversified. It monetized. It digitized. And it never let go. Today, when you sit in a climate-controlled showroom signing papers under soft lighting, you think you've negotiated the price of a vehicle. But you've entered a contract with an ecosystem designed decades ago, refined through bankruptcy, bailouts, and boardroom wars. The engine hum is just the surface. Underneath, spreadsheets are calculating your next 5 to 7 years. Your commute becomes yield. Your maintenance becomes margin. Your data becomes leverage. The car company didn't just sell you transportation. It secured a revenue stream. And the next time the market crashes, when the Dow flashes red and factories slow again, that ecosystem will still be humming. Because long after the keys are handed over, the meter is still running. Next time, we expose who really owns the road you drive on.